All right.
Yeah,
You
option
can take over.
IV leads. Looking, and I'll have to explain it a little bit further. But that's what we're going to be covering, the options IV leads.
All right. You can take over.
Um, okay, let me share my screen here. And I'm on just to illustrate it, we are on the Apple options chain right now. And I'm going to just close this menu just to expand the screen. And we have this feature here. It's called option IV leads. We'll click on that. And you see this table here of data. And what an implied volatility lean is indicating is that when we look at, let me just click on one of these just to give an example. When we look at the market in a particular option, okay, so here we have an Apple, a 210 put. Okay, so these are the July 5th expiration, looking at the 210 strike, and we detected an implied volatility lean in the put. And you can see here on the S side, it's right now a different color. It's in white, so you can see where the implied volatility levels are. Usually we have it in this green color, and then just to point it out, we left it in white so it stands out. Okay. And you could see here that it's highlighted 19.3. And what this is indicating to us is that there's something going on potentially on the ask side of this option, of this put. And when you look at the options, we'll have a bid and an offer, right? The bid is people, the best firm bid people are willing to buy something at. So when I say firm, once this is displayed 158, if somebody goes and sells it, that person is obligated to buy whatever amount he displayed, he's obligated to buy it. Right. So once you put in a limit order out there, it's either a market maker has a streaming quote, you could put in a limit order, somebody could put in a pegged order. Once it's out there and it's being displayed, we call that firm. Somebody's obligated to trade at that price unless you canceled before. Of course, somebody else has to hit that bid. Same thing with the offer. And when we look at a market, you'll have a bid and an offer. Usually you'll have a broker dealer specialist or market maker making a bid or offer, and they have a spread between the bid and the offer. There's a spread because unless they meet, they'll trade. So if there's a bid at one price and then there's an offer and ask at a higher price, well, that we call the difference between the two a spread, and they won't trade unless they meet at the same price. So here we have, you could see a bid of 158, an offer of 163, 5 cents wide. Let me just bring this up for a second. So when a dealer makes a bid and an offer, they're doing it around what they think is a fair value of the option. Okay, so if they think an option is worth, let's say, $1.05, well, they're willing to buy for $1 or sell it for $1.10. They don't care which way, because if they're buying it below what they think is worth, selling it above what they think is worth, that is their theoretical edge, right? That's how the dealer generates their revenue from the spread, the theoretical edge. But of course, there's also the right for people to compete within that spread. So, for example, if you are trying to sell an option, but you don't necessarily want to hit the bid or the midpoint, what you could do is better the offer, right? So let's say an option is $1 to $1.10. Well, you could try to sell something for $1.09 or $1.08 or $1.07. And what happens is then you start squeezing in that state of the market, right? The difference between the bid and an offer. And there's a couple different ways to do it. One is you could put in a limit order, right, which is a resting order. There's another way to do it where you can put in an implied volatility pump, which is pegged to the stock. So you could say, well, I want to sell a 19.30 volatility, but the stock will move around. Well, this option has a delta. So the option, until you get an execution, will move around with the stock. So in the case of a put, if the stock is moving down, the Black-Scholes model will recalculate it based on a 19.30 volatility, and it'll either, as the stock's moving down, it will raise the price of the option. As the stock is moving up, it will decrease the price of the option because there's a delta. And of course, there are market makers competing that could create an implied volatility pump, specialists. And the idea there is that when you detect it, that gives you some information, or that there is somebody potentially looking to negotiate a better price in this option, and he's coming in from the sell side. And that's an opportunity perhaps for somebody looking to buy a put to receive a better price, right? Because now we see a particular option, the 210 put, and I'm not saying it's really for people trying to look for puts to buy and looking for places that they could improve their execution, and somebody's willing to, there's perhaps a seller willing to lower the price or trade at a better price. And this is what the implied volatility pump tool is trying to help detect. Okay, so let's take a look at this one. So we see here that the spread between the bid and the offer is 5 cents, $1.58, $1.63. So here it is. The spread is 5 cents. Oops. Right? And we also see that if we look at the put immediately above, so this is the 212.5 put. So this is a put that's the next strike up. Well, that's 10 cents wide. What about the put right below it? Well, we see 77 cents, 83 cents. That's 6 cents wide. So just between the bid and the offer, we could see that, well, something might be going on here because this one is tighter than the surrounding markets, right? We could even check in the calls here. The calls are 10 cents wide here. This one's 20 cents wide. This one's 5 cents wide. So we could, kind of tell like, okay, here's a market here that's getting squeezed more than the surrounding markets, because all these options around here, have probably deltas that aren't too far apart, gamma, vega, because these strikes are pretty close together. We also see on a relative basis how this option is priced. So take a look here. You can see here that, the bid in the calls in the put, right, is 18.9. The bid in the put above it is 19.5. Below the bid in the put in the strike above is 18.9. But here, look how these offers are. The 212.5 put, the offer is 19.8. So keep in mind, we're looking at the implied volatility to see the relative premium, right? The relative premium, how expensive is the premium in the put, right? If we paid this offer, the Black-Scholes model is implying that the stock has to move at this volatility. So we look at this particular one, 19.3, right? That's below the option right above it, 19.8. It's below the option strike right below it, 19.3. We could even look at the corresponding calls just as a comparison. So you could see here 20.4, 20.5, 22. So even if we ran the Black-Scholes model and said on a relative basis, how does this option look relative to the other ones, right? Because that's how we're doing the analysis, relative to all the surrounding markets. And we see that, yes, something here is going on where the market is squeezed a little bit. There's a the spread, the bid-ask spread, has narrowed relative to the other options. And which side does it look like it's coming in? Because it could get squeezed on both sides, but here it's not that obvious that it's being squeezed on both sides because we don't see a bid that's pumped up relative to the surrounding data, but the offer does look like it's getting squeezed in. And in this situation, and we see there were already 20,000 contracts that traded on this option. So in this situation, looking at this snapshot, this still in time, it looks like perhaps there is an implied volatility pump on the ask. That it's either a resting order, it's either a option that somebody put in a limit to sell at $1.63. It could be a resting order, or it could be a streaming order where somebody may need to sell this particular option. It could be somebody, perhaps selling out of a position or trying to put on a position, and they're looking at this option and want to sell it at a particular implied volatility level. All right. So that's what this is detecting. And of course, then now we got this information, where, okay, there's this option here, trades a lot. Let me see if I could bring this up real quick. So we could see right now some statistics how this option traded. So we see that the VWAP price is 76 cents. Right now the market's higher, 158, 163, traded as high as 180, as low as 46 cents. The last time that it traded was $1.71 over here. And we see that on average, the implied volatility in this option traded at 18.77. The highest it traded is 20.8. The lowest it traded is 17.8, last 18.8. So we could see here that right now, if we use these benchmarks for a fair value implied volatility, we see that it's trading above its average, 18.77 right now. You could see here 18.9 bid, 19.3. So it's about midpoint 19, right? As high as 20.8. So it is trading on where the market right now is sitting at above, right, where the weighted average implied volatility. So we got these benchmarks. So it's not trading below, perhaps it could get pushed lower, right? It could get pushed lower, closer to this. But we've got these benchmarks now and what's going on in the market to give us that information to help strategize. And what else it could do is allow us to look at other options and say, okay, we know that perhaps there's this seller here, and maybe I don't want to buy an option. Maybe I want to even compete on this, thinking it could go lower. That's one way to look at it. Another way to look at it is say, well, maybe I'm not particularly interested in this offer, but if I was able to sell something and spread it off, maybe I would be interested in this offer. Maybe if I'm interested in a risk reversal, for example, if I could sell this option at a 20.5 vol, maybe then I'll be interested in buying this put at a 19.3. So it gives you that type of information to look at, so you could start seeing what are people doing, where have they been trading this option, and how can I strategize around it given this information. Right, so that's an example of an implied volatility pump. So when we come here, I'm going to click on this. Okay, here up top, we list the top 5 implied volatility pumps based on where the volume in the option. So if there is an implied volatility pump, and then there's also volume in that option, we'll list the top 5. So you could see here the July 5th, 210. This had almost 21,000 contracts traded, and there's a lien on the ask, right, of $1.63. So if you're looking at it and quickly saying, well, I'm looking maybe perhaps at buying a call in Apple or put or selling, are there any liens here in the top 5 that have options traded? And here and of course, some you could see here there are more implied volatility liens with these are all of them irrelevant if there's a volume in it or not. But the idea behind the volume is that there's a lien, but we could also open up our statistics and be able to analyze what the fair value or what the average implied volatility of the most recent trades, because now we have more information to help us with the price discovery, right? So now we could even benchmark, well, where are people trading? Where are the buyers and sellers meeting? What is the range, right? Not just the average, but what is the range of the buys and sells? Is the implied volatility all over the place? Is it usually traded around a certain, level? And by analyzing the trading volume, we could gain that information. And by doing that, it helps us also with the way we place our orders and to get better price execution, right? So let's just look at another one. Let's say here's another November 235 call. There is a lien in the ask, and the price is 505. If that doesn't just skip it. But if it looks interesting, we could click on it, right? So now we go to the November 15th expiration. We see it's going to cover earnings. This is far away, by the way. This is 98 trading days. So there could be, a couple earnings here. And we see that here it is, the 235 call, right? This is the November 15th, 235 call, has 5,000 contracts that traded. And here we see the bid is 490, the ask is 505, and the implied volatility is 22.8. So same situation. Let's open up our stats here, the spread, implied volatility, and lien. So here we go. There's a lien on the ask. It's 15 cents wide, so it's similar to it's equal really to the below and above, but it looks to me like the following. This, you can see here that the option below the 210 is 22.8 bid implied vol. The option above is 22.8. but this bid is 22.5. So the bid is, this bid you could see has faded. It looks like, why is the bid in this particular one lower than the implied volatility in the option below and the option above? And same thing on the offer. You could see that the offer here is 23.1. The offer above the strike is 23.1, but this one squeezed in 22.8. So in this situation, it looks like the option implied volatility faded on both the bid and the offer. Maybe there's selling pressure there. You know, there's 5,000 contracts here. But that's very noticeable where you're like, you know, here we have on both sides of the market, the dealer faded. Both sides. So let's take a look at it. So take a look at the option. And here we have this big trade here that sticks out. Almost 5,000 contracts traded at $5.67, right? On the NASDAQ, within the average implied volatility is 22.3. 22.3, you know, with 22.6 at the high end. 22.3 really at the low end. So if we just compare it to at this point, you could see it's a little bit higher, right? 22.5. But it does look like the market in that option looks like it faded lower. Okay, that's the indication from this snapshot. All right, well, we're right up at 9:30, so I'm gonna stop right there.
Yeah, that's good, D. We did have a question from Rob earlier, and it was about the dividend screener. I'll read it to you now. You can either answer it now or we can look at it tomorrow. It says in the dividend screener, it has a heading of payout ratio under the most dividend increases side tab. What does that payout ratio relate to? You want to answer that tomorrow? I'll copy it and send it to you.
Yeah, let's just go over that tomorrow because it's a different topic. But yeah, but thank you for the question. Yeah, we'll take a look at that tomorrow.
Awesome job, D, as always. Thanks, Chameleons, for the questions and for coming by. Great job, buddy.
All right. Thanks, everyone. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Yeah, everyone have a great 1st of July, and we'll see you tomorrow. Bye-bye.